In the last 3 years, something unprecedented has happened. Central banks around the world have stopped selling gold. They've stopped being neutral. They've started buying. Lots of it. But here's what's making investors lose sleep at night. While Western governments debate interest rates and inflation, a very different kind of war is reshaping the global financial system in real time. And some investors are about to get extremely wealthy from what comes next. Most people are missing this entirely. They're watching the headlines. They're looking at stock markets and Fed decisions. They're doing what they've always done. But that's only the surface explanation. The real mechanism is far darker, far more structural, and it's already in motion. So if you're concerned about inflation, currency debasement, geopolitical risk, or wealth protection, the next few minutes might change how you think about your portfolio forever. Stay close. Right now, millions of investors are experiencing something deeply uncomfortable. They're confused. They're angry. They're watching the purchasing power of their savings erode month after month. Inflation is supposed to be cooling, right? The Federal Reserve told us it was transitory, it was temporary. But it's still here. And the more painful part? Even when inflation headlines improve, your grocery bill doesn't. Your rent doesn't. Your energy bills don't. You can feel it in your life, but the mainstream financial media keeps telling you everything is fine. Here's what most people miss. That confusion you feel is not a personal failing. It's not that you're not paying attention, it's that you're being told an incomplete story. The stock market is at record highs. Unemployment is historically low. The Fed is holding rates steady. By every official metric, we should be in paradise. Yet the average American is more financially stressed than any time in the last decade. Something doesn't add up. And it doesn't add up because the traditional economic machine that worked for 70 years is breaking down. But that breakdown has a timeline. It has a sequence. And for people positioned correctly, it creates opportunity most investors will never see coming. Let me walk you through the real mechanism. This is where it gets important. Step 1. Understand that the entire modern financial system since 1971 has been built on a single foundation: trust in the US dollar. Not as a commodity backed by gold, but as a currency backed by faith. Faith that America is stable. Faith that the dollar will hold value. Faith that the US government can manage its finances responsibly. That faith is the only thing holding up the entire system. Step 2. Look at what's actually happening to US government finances. The national debt is now over $33 trillion. Every single year, the government spends more money than it takes in. This year alone, the deficit will exceed $1.6 trillion. That means the government is borrowing $2 billion a day just to keep the lights on. That's not opinion. That's math. Step 3. Now add geopolitical tension. Right now we have wars on multiple continents. We have a fractured global order. We have nations that used to be locked into the Western financial system now openly building alternatives. BRICS nations are creating new payment systems that don't depend on the dollar. China and Russia are conducting massive central bank gold purchases. The euro is weakening. The yen is collapsing. And here's where everything changes. These three things together create a very specific scenario. A scenario where the currency that everyone assumes is invincible suddenly looks fragile. History shows this pattern again and again, but people keep forgetting. Look at Britain in the 1940s. They had been the dominant global power. Sterling was the reserve currency. They had an empire. But after World War II, they had massive debts. Their currency was overextended. Their geopolitical position was weakening. And what happened? Over the next 20 years, sterling lost over 80% of its purchasing power. But before that happened, before the collapse became obvious to everyone, there was a specific asset class that protected wealth: gold and silver. Look at the US in the 1970s. Vietnam War, massive government spending, rising deficits, inflation that wouldn't stop. The government kept saying it was temporary. They kept saying it would pass. But investors who understood what was actually happening moved into precious metals early. Gold went from $35 an ounce in 1970 to over $800 an ounce by 1980. That's a 22-fold increase. A retired person with foresight could have tripled their wealth while everyone else was losing sleep. Look at what happened in Venezuela, in Turkey, in Argentina. Every single time the pattern is identical. Massive government debt, geopolitical weakness, currency pressure, and what always protects wealth? Physical assets, real things, the things governments can't print. But here's the crucial part. It never happens overnight. It's a slow-motion train wreck that accelerates. And there's always a window. A window where you can see it coming, but most people haven't acted yet. That window is closing. Why does this time feel different? Because the scale is bigger. The US debt is not just large, it's astronomical relative to economic output. It's nearly 120% of GDP. We're approaching a level where simply servicing the interest on that debt starts consuming every dollar the government collects in taxes. We're basically already there. Last year, the US government paid over $600 billion in interest payments alone. This year, it will be higher. By the end of the decade, interest payments could consume 20 or 30% of all federal revenue. That means less money for defense, Social Security, infrastructure, everything. And you can't print your way out of this kind of debt trap in a geopolitically contested world. Because the moment other nations lose confidence in your currency, the trap springs shut very fast. Look at what central banks are doing. The People's Bank of China has been buying gold. The Central Bank of Russia has been buying gold. The ECB, the Reserve Banks of India, Australia, Japan, all accumulating gold at rates we haven't seen since the 1970s. Why would they do this? Why would nations that could hold dollars, hold bonds, hold anything, choose to buy physical gold? Because they know something. They know that gold is the only form of wealth that has no counterparty risk. No government can devalue it with bad policy. No central bank can print it into irrelevance. No corporation can go bankrupt and take it with them. Gold is wealth that doesn't depend on believing in any system. It's insurance against the system itself. And when central banks start buying that insurance in volume, it's not because they're being paranoid. It's because they're reading the same macroeconomic data we're reading. And they're making a choice about what the future holds. So what happens next? Here's the phase sequence most investors don't see coming. Phase 1, we are currently in it, is denial and policy bluffing. The Fed keeps raising rates just enough to look credible. The government keeps saying it will get fiscal discipline. Interest rates keep creeping higher. This creates an illusion that the system is stable and in control. Most people believe this phase because it's the easiest to believe. It requires no change. It requires no difficult decisions. Life goes on. But this phase is ending. Phase 2 is the deterioration of confidence. This happens when something breaks. It could be a recession that's deeper than expected. It could be a geopolitical event that shocks markets. It could be a sovereign debt crisis in Europe or Japan. It could be a sudden spike in inflation. What matters is that it's a moment where people start to question the assumption that everything will be fine. You see this in currency weakness. You see this in increased demand for safe haven assets. You see this in central bank buying accelerating even further. This is when gold starts to move. Phase 3 is the repricing. This is when the market finally accepts that the dollar's strength is structural, not eternal. This is when investors who've been holding dollars suddenly want out. This is when the currency weakens, when inflation accelerates even from already elevated levels, when precious metals don't just rise, they explode upward. History shows us that in these moments, gold can move 50, 70, even 100% in a single year. Phase 4 is the institutional reset. Governments introduce new currency systems. We possibly see a reevaluation of global monetary order. Some nations' currencies collapse, some strengthen, but everyone has to recalibrate. And investors who held real assets, who held gold and silver, who held things with real utility and real scarcity, they're the ones whose wealth survives the transition intact. The question is not if this sequence happens. The question is when, and how violently. Now, what should you be watching? What are the key indicators that tell you which phase we're actually in? First, central bank buying velocity. Keep a close eye on the World Gold Council reports. When central bank gold purchases accelerate dramatically, that's a signal that institutional investors are genuinely worried. We're seeing historic levels right now. If this accelerates further, it's a warning sign. Second, the US dollar index relative to basket of other currencies. If the dollar starts weakening substantially while US interest rates are still high, that's a major red flag. It means foreign investors are losing confidence in dollar strength despite higher returns. That's historically preceded major precious metals rallies. Third, real yields, meaning bond yields adjusted for inflation. When real yields go negative, when the return on US government bonds doesn't even beat inflation, suddenly gold with zero yield looks attractive. We're seeing real yields approach negative territory. Watch this closely. Fourth, geopolitical risk premiums. Watch crude oil prices, watch gold lease rates, watch volatility indexes. When these spike without corresponding economic news, it means markets are pricing in tail risk. It means smart money is hedging against something breaking. If you see all four of these moving in the same direction at the same time, you're not in phase one anymore. You're transitioning into phase two. That's when the real move begins. Here's what this all means for you. We are in a moment where the old financial order is visibly breaking. The US government debt is unsustainable on a long enough timeline. Geopolitical conflict is making dollar dominance contestable for the first time since World War II. Central banks know this. They're positioning accordingly. But most retail investors don't see it yet. Most people are still in the denial phase. They're still thinking in terms of stock market gains and traditional portfolio allocation. They're still trusting that the institutions will manage this smoothly. The institutions will not manage this smoothly. But here's the opportunity that almost nobody talks about. The investors who understand this sequence, who position early, who understand that physical precious metals are insurance against currency debasement and geopolitical instability, those investors are going to see wealth protection that others can't even imagine. This isn't about getting rich quick on speculation. This is about understanding that in a world where trust in currency is eroding, real things matter. Gold matters, silver matters, assets with real utility, real scarcity, real history as stores of value, these matter. The window to position is still open, but it's closing. Central banks are positioning. Smart money is positioning. The question is whether you will. Because here's what most people miss. The investors who get wealthy from what comes next aren't the ones betting on the disaster. They're the ones who simply protected themselves while everyone else was sleeping. They're the ones who held real assets while everyone else held promises. And when the repricing comes, when the currency weakens, when precious metals finally reflect what they should have been worth all along, their purchasing power will be intact, their wealth will be protected, and they'll look around at everyone else and realize they saw something others didn't. That could be you, but only if you act before the moment becomes obvious, and by then it will be too late. The signals are there, the precedent is there, the mechanism is clear. What you do with this information is your choice. If you want more deep macroeconomic analysis like this, if you want to understand the patterns that are shaping global finance before they become mainstream, subscribe to the channel and stay close. We're going to be covering this story closely in the months ahead, because the next few years are going to define whether you protected your wealth or lost it to forces you saw coming but didn't act on.